This is FRM Part 2, Book 2, Credit Risk Measurement and Management, and the chapter on credit scoring and retail credit risk management. Now, up to this point in these series of chapters, we have been focusing on large investment banks like Goldman Sachs or JP Morgan Chase or Barclays, and we've been concerned about their derivative portfolios and credit value adjustments and expected positive exposure. What we're doing is going to shift away from the large over to the, well, not really small, but historically it is small when we talk about the retail banking industry. When I was in graduate school, my first efforts in graduate school, back when I was working on an MS, I don't have an MBA, I have an MS. But I had a banking professor the very first day of class, and this professor was really, really awesome. And he said something to me that I use regularly, and I'm sure I've said it to you guys. He said, a commercial bank does two things. It accepts deposits, and it makes loans. And that's essentially what we've narrowed this entire conversation down in the retail industry. Let me show you what I mean by looking at these learning objectives. All right, so notice the first one there, retail banking. Sometimes this is called consumer banking. So credit risks and other risks at the individual level. We'll take a look at some credit scoring models, and then we'll move into a cumulative accuracy profile, which will be an illustration that is fairly interesting. In the meantime, we'll talk about some definitions and some things that I bet you guys are probably aware of, just because you've borrowed money to buy a house or borrowed money to buy a car. And then we'll end with some benefits of risk-based pricing on our last slide. Let's go back to what my professor said. What is retail banking? Accepts deposits and it makes loans. And so typically it's characterized by a large number of small, low-value loans, right? So what have I done in the last 20 years of my life? I borrowed, however much to buy my house or houses, 3 houses in our marriage, $20,000 to buy a car, $15,000 to buy a car. I use credit cards all the time, I guess. All right, so consumer banking, business financing, or both. And so, you can think of it as consumers or individuals, or, self-proprietors, or, individuals who own their own business. And so, those kind of things, they get muddled in terms of distinctions. Notice that third circle point. Incremental risk of any single exposure is small, right? If I default on my $15,000 car loan, does the bank really care? Yeah, of course the bank cares, but it's probably not going to send the bank into financial distress. And so there are the mortgages, there are the auto loans down on the left-hand column, and then credit cards and revolving credits and installment loans. That should make perfect sense. Now, there's a big section in this chapter about the risks to which retail banks are exposed, and I added my own definition up there in the heading. I always tell my students, and I know I've said this to you guys before, think of risk as the variability in outcomes. So if you look down that left-hand column, we have all different sorts of risks associated with retail banking. Let's examine how each of those is some kind of variability. Now, we've spent a lot of time talking about credit risk, and so this credit risk, of course, is the risk that the homeowner or the car owner is going to default on that debt. So credit risk really is the variability in the value of those loans due to probabilities of default. Now, interest rate risk, can take on lots and lots of different animals as it has changed over the years, and depending on individual types of loan contracts. But in general, you think of the bank's balance sheet, you've got liabilities over here and assets over here. And so the interest rate on the left and the right-hand side of the balance sheet is not going to be the same. I mean, what does a financial institution want to do? I mean, ideally, right, it would say, okay, let me accept these deposits and I'll pay you 1%. And so tons and tons of people come in and provide that capital, and the bank is only paying 1%. Wants to take that capital and lend it out and charge the borrower, let's say 100%. And this is a risk-free rate. Suppose all these borrowers are guaranteed to repay. So that spread 1% to 100%, of course, that's the profitability center for a financial institution. So interest rate risk involves that spread, but it also involves, of course, you guys should know this from your asset liability management days, that you have variability in the value of the liabilities and variability in the value of the assets depending on interest rates. Asset valuation risk. Now, we talked about this when we were looking at the big banks and we were talking about credit value adjustments and the need for contractual netting arrangements and collateral. Of course, we need to come up with an accurate estimate of that collateral, even at the retail side. I have a house, so we can have someone come in and appraise my house, and they could say, okay, Jim, you've got this and this and this, and here's the neighborhood that you live in, here's the school district that you live in, and so your house is worth X amount of dollars. But how accurate is that? Because, of course, I bet you've heard stories, just like I've heard stories, is that some appraisers will just get in their car and drive slowly by my house, and they'll look at my house, and then they'll go make some assessment on that value. Of course, not all good appraisers are like that, of course, but it does happen. So asset valuation risk, an accurate value for collateral or what's on the left-hand side or the right-hand side of the institution's balance sheet. Now, business risk is the variability in the value of the financial institution as a result of the bank's business strategy, right? Business strategy is typically set by the board of directors, and the board will sit around and say something like, you know what, we should focus on mortgage loans, or we should focus on credit cards, or whatever it is. And so business risk is the variability in revenues and expenses depending on the business strategy. For instance, fluctuations in mortgage business volume. Operational risks have everything to do with the actual quality control inside of the supply chain or the flow inside of the financial institution. Failure in quality control. Fraud is, of course, the best example there. Reputational risk, failure in managing intangible assets, human capital, let's call it, reputation. Financial institutions have taken a gigantic hit at discrete intervals over the years. Just go back to the financial crisis of 2008. Politicians were saying something like, oh, those greedy Wall Street bankers. Well, that doesn't sound like we're increasing or valuing the reputation of those banks, right? They let us down, so to speak. What do I have written there? Failure to deliver on promises made to customers and regulations. Oh boy, isn't there a gigantic bank out there who did some things that it should not have been doing and has been slapped on the wrist by all sorts of U.S. regulators? I'll let you guys figure that name out. How about the difference between lending to individuals and lending to large corporations? This is probably a good slide to know. Excuse me. So retail credit risk comes in, pretty much small sizes. We said this earlier, not trigger a financial loss big enough to threaten the bank. Customers tend to be financially independent. Just take a look at my neighborhood. I'm a college professor. I have neighbors who are accountants. I have a neighbor who's a salesman. I have a neighbor who's a school teacher. I have a neighbor who is a pilot. So their jobs are in different industries, and so they probably have little economic ties. Of course, with some type of a virus that shuts down everybody, and so I don't really know where that fits into the whole model, but it ought to fit somewhere. Now, it's relatively easy, or at least historically it has been, if financial institutions are sensitive and are able to locate and identify and quantify all of these inputs. You can come and drive around my neighborhood and you can probably make a pretty good estimate of how many homes are going to default within a 30-year time period. So reliable estimates. And then there are easily noticeable warning signals. Of course, if I lose my job, or the pilot loses his job, or the school teacher loses her job, that's a pretty good signal. Now, on the other side, on corporate credit risk, a local business may come to the financial institution and say, I'd like to borrow $400,000 or $4 million or $40 million. That might be too much, but what it can mean is that particular loan is a much bigger piece in the portfolio puzzle. And so what do I have? It can lead to significant financial turmoil if there is a default. Of course, these tend to be concentrated portfolios because we might lend to the baker, and then we might lend to a manufacturer of coffins, and then we might lend to a restaurant, and we might lend to a bike shop, the owner of a bike shop. So we have all of these loans that are tied to the local economy. And so if that local economy suffers, and people ride their bikes less, and they eat less, and they buy fewer donuts, right? Especially as it relates to this geography. Now, those concentrated exposures, coupled with the size, makes modeling much more difficult. And so remember, when you have a model, if it's easy to predict, you're going to have a relatively small standard deviation. If it's not, then you're going to have a large standard deviation, however you want to measure that or assign values to that standard deviation. And then, of course, it's much more difficult to notice warning signs because they're spread out among lots of different points inside of that population. So I would know this table here about the differences between those two. That, in fact, is Darth Vader up there at the top, the dark side. And by the way, I was in high school and college during those first 3 Star Wars movies. I wonder if many of you were even born then. But those were fascinating movies. The later 6, were, either average or below average, at least in my estimation. Although it was worth watching those 3 movies just to see Darth Vader's helmet come on top of his face. That was worth whatever bad cinema was from those other models. Anyway, so what is the dark side of retail credit risk? All right, so what do we know? We know since, let's say, 1980, there have been tremendous advantages in new products, especially new credit products. And so you have these new products, and they present all different sorts of challenges, including pricing challenges and modeling challenges. And what happens then is that when there is some type of an economic downturn, when there are highly correlated factors that move against the financial institution at the same time, right? Just when you really want a diversification to work, it doesn't seem to be too helpful. Of course, that's an element of this dark side. And so what can happen is that, you have some of these factors like unemployment or interest rates or oil prices. What that can do is that can increase the number of defaults in that particular area pretty quickly and pretty dramatically. Now look at the third block point there. Retail banking is especially prone to operational flaws. This is really an interesting part of this credit risk management because you rely on fewer and fewer people, and then you have products that are being offered to individual consumers out there that tend to be higher risk. What happens then is that there's a model or a decision-making process that probably takes some of the human element out of it and puts it into an algorithm. So it's an automated process which may or may not identify the marginal costs and the marginal benefits of that particular contract. Now, I put that last block point in there because the textbook does. The social and legal environment may inadvertently encourage defaults. Is there a stigma attached to defaulting on your mortgage or your car loan? I'm guessing there is. That's why our local municipality publishes the names of those people who are, 6 months late on either their property tax payments, or we pay the municipality for sewage and garbage. We do that separately, so your name gets in the paper. Oh, hey, by the way, Jim hasn't paid $400 for his for his sewage bill, and by the way, Jim lives here on this street. Why don't you drive by Jim's house and raise your fist at him and say, Jim, how can you be doing this? Now, lots and lots of processes and solutions and resolutions came out of this financial crisis back in 2008. Of course, one of the major ones was the federal legislation, the Dodd-Frank Act, which passed in 2010. And I remember when we were going through this time, and not only was the Fed talking about this, but the president was talking about this, and Congress was talking about this, the need to bail out these banks. And I would scratch my head and say, why not just let them fail? We have a whole court system to kind of figure it out. However, our leaders decided that we need this, and we probably needed a bunch of it. But I do remember that the goal was to establish a scenario under which there would be financial stability inside of the financial institutions industry. Has that been successful in the years after that 2010? We'll find out pretty soon, I would think. So this act gave the Financial Stability Oversight Council the authority to do all sorts of tough stuff. So monitor financial stability, increase reserve requirements, and to force banks to chop the left-hand side of their balance sheet and sell their mortgage business or their auto loan business, et cetera, et cetera. Consumer Financial Protection Bureau came up with some of these inputs for a qualified mortgage, ratios. This is not really new, but we had a debt to income ratio. You can't charge 4 or 5 points, no negative amortization. And these were all the result of, going back to 2005, maybe not that year, but 2006 and clearly 2007, when these mortgage loans were being made. What were they called? No document loans, no doc loans, or liar loans. And so this act was an attempt to get rid of all that stuff. Now, the big thing for retail credit risk management is to be able to identify an individual when he or she walks into the bank and asks for a loan as being either someone who is going to repay the loan or someone who is going to default. And so how do you do that? Essentially, and I've shown you this example before, essentially what you do is you look at the amount of the loan, right? The amount of the loan is this big, let's say. Well, if the individual walks in and has this much in assets and this much in income, then they're probably going to be able to repay the loan. But if the loan is this much and the assets are this much, and income are this much, then you have just the opposite end of the scale. So one way to do this is to come up with a credit risk scoring model. So look at there. We go all the way from 300 all the way to 850. 850 is excellent credit score, all the way down to 300, which I think is the minimum. And so you take lots and lots of variables from the individuals and you put them in some type of a credit scoring model. and the computer then spits out a number, right? So the higher the number, the more likely that the borrower is going to repay full amount and in a timely manner. Remember both of those concepts. So make sure you know the difference between a characteristic and an attribute. So characteristic, look at the table there, number of years, annual income, years in a previous job, age, and you come up with 100 of these if you wanted to. And then there's the specific attribute as it applies to the individual borrower. So you take these four, and it's probably not just these four, but maybe it's 14 or 40, and then you throw them into some type of an algorithm, whether it spits out some linear programming or some other kind of mathematical programming, or regression, or some kind of tree. I'm a big tree guy. I love it when we start here and we go branch and we branch and we branch and we branch. I always loved that. I was fascinated by that when I was in graduate school, when I first saw an interest rate tree and how you can use an interest rate tree to price a bond, especially a callable bond. Boy, that fascinated me back in the old days. I don't seem to be able to convince my students these days that that's fascinating stuff. All right, I bet you guys know about this credit bureau model, often known as a Fair Isaac Corporation score, a FICO score. So less than 580 poor, up to 850. I guess you could have higher than 850. I'm not really sure. I've known that. Every once in a while I come across my personal credit score, and I don't ever remember what it is because I don't really borrow all that much, but I do borrow every once in a while. Like a couple years ago, I went to Goodyear and my wife needed 4 new tires, 4 new rotors, and 4 new brake pads. This was $1,500 or something. So I used the Goodyear credit card so that I didn't have to pay interest for 1 year. Why would I not do that? But somehow applying for that Goodyear credit card, because the interest rate was, I guess, relatively high, that lowered my credit score. But after I made all those payments for a year, what is that, $150 a month or so at a 0% interest rate, somehow that raised my credit score. And you can access pooled models, which are done by organizations that take a look at a wide range of lenders that have similar credit portfolios. Of course, you have to pay for this because it's a little bit more flexible, and you can design it so that it relates or pertains to the kind of clients that the financial institution attracts coming into its bank, right? And then the most costly is a custom model, and I'm always in favor of custom models. What you can do, let me go back here. You can rely on other people, or you can rely on other people. Maybe some of those people are your own people with the pooled models, but you're still relying on others. Or you can do it yourself. And I'm a big fan of trying to figure out how to do it yourself, right? Identify the risk, quantify the risk, manage the risk. A lot of that stuff you can do yourself, whether you're an individual or, in this case, if you're a financial institution. And so this comes down to marginal costs and marginal benefits. And I believe there are tons of marginal benefits that may or may not be able to be accurately quantified, at least in the short term. I mean, you can figure out the costs, right, pretty quickly. Key variables in a mortgage credit assessment. All right, so we have that FICO score. We just talked about that. How about a debt to income ratio where you have monthly debt payments? So these would be any kind of other mortgage payments. Maybe you have a house at the beach. These would be car payments. These would be student loan payments. These would be, how about this one? Payments to your parents for being such generous parents. I currently have $0 coming from my children for those payments. Anyway, divide that by monthly income, and you kind of get a sense of whether or not that individual is able to handle the monthly payments on this incremental loan. Loan to value ratios. I mean, these are tremendously important for mortgages. I mean, I don't know how important they are in the auto loan market, but clearly in the mortgage market, these are critical. And so this is what I've taught my children, even though some of them are not old enough to buy a house, is that you need to start saving now. You need to start saving now so that you have this much of a down payment when you want to buy a house. And then, of course, the payment type, adjustable versus the fixed rate. Let me tell you a quick personal story here, that when my wife and I bought our second house, this is back in 1996, the difference between fixed rates and adjustable rates was at an all-time high. So we did an adjustable rate mortgage, and my monthly payment was like $530 a month. And the next year, the rate, of course, it adjusts upward, and our payment was $711. And then the next year it went up to $830, and that's when I said, boom, I'm gonna refinance, and I locked into a fixed rate. And of course, during that time period, I guess I was lucky, that difference didn't continue to accelerate. That difference actually converged. Convergence for me was good. Convergence for long-term capital, for those of you who watched that evolution video, wasn't so good. All right, so how do we decide? If we go back to that one thing where we had the pink was 300 all the way to the green was 850, how do we decide as a financial institution whether or not we're going to lend to the next person that comes in? And let's suppose that we open our bank doors, and there are two people that walk in the door that morning. We have someone like, let's say, Michael Jordan, who was arguably the greatest basketball player of all time. And by the way, my father was a great basketball coach and a great evaluator of talent. And he always said Oscar Robertson was the greatest basketball player of all time. And then somewhere around 1988, he looked at me and said, Jordan is better than Oscar. So I'll take my dad's word for it. So you have Michael Jordan, who has this much income, right? You can't even see my. Let's suppose he comes in and wants a $100,000 loan. And right next to him is my college-age son, who is still in college, so he doesn't have a job. Who knows if he's going to graduate, right? Who knows what kind of a job that he's going to get? But he wants a $100,000 loan. I mean, clearly these two individuals are not the same individual. They don't have the same ability to repay this loan. Is a credit score enough to help us make that decision? We need a model. We need a credit score model and maybe some auxiliary and additional models to help us identify, look what I have on the left, the defaulters, which would be my son, and the not defaulters, which would be Michael Jordan. So you have a population of defaulters and a population of non-defaulters, right? So we can draw a bell-shaped curve for each one of them. And so in this case, let's just suppose we pick a cutoff score of 680. So there's the vertical black line right there at 680. So let me go like this. I mean, what could we do? We could move that all the way out to 800, and then what would happen? We wouldn't make loans to hardly anybody, right? So where's our income? Where's our interest revenue, right? Or we could move it all the way over to, let's say, 350, and we could make billions of dollars of loans. But once again, where is our revenues minus expenses? Where is our net income going to fall, right? So what we're trying to do is put that somewhere in the middle that minimizes that overlap. Ideally, you would have people coming in who clearly should be rejected, and people coming in who are clearly should be accepted in terms of the loan, right? But you don't have that. You got all these people somewhere in the middle. So how do you distinguish and differentiate between those two people? And so this goal here really is just to minimize that overlap. Notice there are, in the bottom there, I have false bads and false goods. That's kind of like type 1 and type 2 errors. Now, the governing bodies out there, especially after the 2008 financial crisis, mandates, that's important. It doesn't recommend, it doesn't suggest that banks must group their portfolios into different types of sub-portfolios or subgroups that have similar loss attributes, right? And so they need to calibrate that score that is indicative of the different levels of risk. And from my perspective, this is a good thing, right? My son and Michael Jordan are not the same person, so they should not be in the same group, right? So you can compute an implied probability of default, pretty quickly there, 7.5%. And so note, the probability of default and the loss given default must be estimated for each subgroup. So all that stuff that we talked about in the evolution chapter and in the CVA and DVA chapters, remember there was a summation sign in those formulas. And so what we need to do is have that summation sign in each subgroup here at the retail level. Now, back when we were talking about the learning objectives, I said we've got a relatively interesting graph that's going to come up later on, and here it is. So this is what we want to be able to do. When Michael Jordan walks through the door, now let's just suppose we don't know anything about basketball, right? So Michael Jordan walks in the door, and he sits down at our desk, and he gives us some information, and we put it into the model. What we want to do is we want to, with 100% accuracy, be able to say, Michael Jordan will be able to repay this loan. And then when my son walks in the door and he requests a $100,000 loan, we want to put all his information in, and we want to be able to, with 100% accuracy, predict that he's going to default on his loan. All right, so that's the goal. And so notice what this illustration looks like. Percentage of actual default, so that's cumulative going up the vertical axis from 0 up to 100%. And then on the horizontal axis, these are really just credit scores, but you can't put 300 there at the origin because for some reason lots of people just freak out if the origin is not 0 and 0. So let's do high risk 0% all the way up to low risk 100%. So we do some kind of a ratio there. All right, so what's the thing here? What we're trying to do is we're trying to come up with a model that accurately predicts default. And that's the green line. This is what we would call the perfect model, right? So for example, if 20% of the population defaults, we would be able to identify those 20%, right? That's a perfect model. Of course, there's no way you can handle uncertainty and become perfect. So that's why it goes up, and then it just, at a right angle, it goes over. Now the blue line is the result of a model that would not be able to distinguish between Michael Jordan and my son, right? So you think of that model. So you have these two individuals walk in, and this model just flips a coin and says, all right, you're good and you're bad, or some other way. So it cannot identify or distinguish between those two. Now the actual model, it looks like that efficient frontier, that Harry Markowitz non-linear arc that goes from the origin all the way up. And so notice what happens here is that, the slope is steep early on. It's not as steep as the perfect model, but it's steep. And then of course it flattens out as you get way, way over there to, boy, can I put Michael Jordan over there in the 100% range? Of course, you ought to be able to accurately predict that. All right, so what do we do here? Let's take an example. Let's suppose that according to the bank's models, 20% of the accounts will default in the next 20 months. So there's that red line, there's the 20%, so that goes all the way up to 100%, right? So that's the perfect model. So if we had a perfect model, the actual number of defaults recorded over that 12-month time period would correspond to, that, let's call it the second decile, right, to the left of that red line. Now the blue line is one that's totally uninformative, so there's no way that that blue line is going to help us out. But what it does is it gives us an idea of the worst model out there. And so what we want to do is, we want to maximize the distance between the blue line and the green line, given the fact that, perfect models, A, are costly, and B, they're unattainable, and C, there's probably something else in there that's going to prevent us from getting out to perfection. Now, this can be summarized in what your chapter refers to as an accuracy ratio. And so this is just the difference between, the green and the orange, but essentially it's a ratio. So we've got to do areas. So the area between the current model and the diagonal, and the area between the perfect model and the diagonal. And so, of course, if this model is 1, then it's going to be perfect. And so as it approaches 1, so if you look at that, it's 1 all the way down with my son, right? Because and it's all the way at 1 because of Michael Jordan, right? And so somewhere in between, those people who come in, who are in between the financial positions of my son and Michael Jordan, that's going to be somewhere with those orange triangles. Look at that, the complex interplay of risk and reward. And I do this to you guys all the time and my children. Marginal costs and marginal benefits, that's the microeconomics way of determining some type of a decision model. But of course we can go back to Harry Markowitz and William Sharp to relate that marginal cost, marginal benefit to, returns, expected returns and standard deviation of returns, or beta or value at risk, or sum, risk and return. All right, so what do we want to do? Do we want to have a conservative policy or do we want to have a profit-driven policy? All right, with a conservative policy, what are we going to do? We're going to have highly creditworthy individuals. Do I want to go all the way back to this thing here? We move that vertical black line, we push it all the way over there, right? So let me swing back here to, one too far. Okay, limited profitability, we said that earlier. And of course, if we're only bringing in the best customers, then they're going to look at us and say, oh, I bet I can get 50 basis points less over at that bank over there. Do you want me to get in my car and drive over there? Now, if we're profit driven, then we're going to move that vertical line. I won't go back to that previous slide. We're going to move that to the left, right? So we have higher probabilities of default, but then of course we're going to charge them a higher interest rate. So we have to weigh marginal cost, marginal benefit. We have to weigh whether or not the higher probabilities of default are acceptable, given the fact that even though we're earning a higher rate of interest, that more of those loans are going to default. So there we go. Expected losses are going to increase, and good risks, those are probably going to stay away. All right, lenders have to find a way to balance profitability and risk. Of course, this is true about life, not just retail bankers. Now, there's a small section in the chapter about this customer relationship cycle. So what's going on as the financial institution? What do? We open our doors. We do 2 things. We accept deposits and we make loans. So we need to get people into our business. So how do we do that? Marketing initiatives. So we do whatever the marketing people tell us to do. We pick up the phone and call people. That's probably not a good idea. We put up a billboard. We do some commercials. So we get Michael Jordan to come on the TV and say, hey, I couldn't have done this without Jim's bank. Or we come up with this special loan. We say, hey, look, we know that you people in this area, you need this kind of a loan with these terms. We're the only bank that does it. So then we have all these new people rushing to our doors and saying, okay, we love to be a part of your banking family. This is what we want. Well, then we've got to decide, do we want to accept or reject these people, my son or Michael Jordan and everyone in between? So what we're going to have to do is say yes to Michael Jordan and charge him, let's say a 1% interest rate, right? Because he has a 100% chance of repaying. So then as we move down, we raise the interest rate all the way to my son. I mean, seriously, we don't want to reject my son. We don't want to turn business away. It's not like Sam Walton will stand at the front of Walmart and look at someone and say, what are you here for? Oh, to buy a vacuum cleaner. I'm not sure I want to sell you a vacuum cleaner. Go over to Target. They have good vacuum cleaners, right? So we don't want to say no to my son automatically, but we want to make sure that when we say no to my son, that we have good reasons. One of the things is to say to my son, okay, what did you want? $100,000. How about if we lend you $5,000? Get your feet a little wet, repay that loan, then come back and maybe we'll increase that. All right, so then we accept some of this, we accept a sample of these populations. Then how do we manage the accounts? My son may say, okay, 5,000. Tomorrow he may call back and say, I need 8 more thousand, and then 12,000. So we increase or decrease credit lines. And of course, we have to collect the principal and the interest. And then we've got to manage things like collateral and manage things like repossessing a car, all those kinds of things. Yeah, risk-based pricing. Yeah, this is of course what we want to do. Most banks, of course, understand this concept that the one price fits all. Right? We're not going to charge Michael Jordan and my son the same interest rate, because it leads to people faking us out. Right? We've got all sorts of things. We have information asymmetry. And one of those consequences is this concept of adverse selection, where people try to fake us out and say, oh yeah, I made a lot more money last year than what I really did. So look at that circle point. Banks inadvertently attract bad risks to whom the product is attractive while keeping away good risks. All right, so banks have resorted to this risk-based pricing. Different customers are charged different prices based on their associated risks. This sounds like something that you would have learned in kindergarten. And that takes us through our learning objectives. I think the most important parts of this series of learning objectives is being able to understand the difference of what we've done in the previous chapters as it relates to, the investment banking world versus a retail credit world. And so good questions on the exam probably would focus on those differences. And then, of course, you have to understand the cutoffs and default rates and loss rates. But, if you focus on the credit scoring models that we talked about, I think you'll be okay. And then make sure you can cover that illustration. What do we call that? The CAP, the cumulative accuracy profile.